Welcome to The Explainer. Today, we need to talk about a hidden risk in health insurance that could leave you and your family dangerously exposed, right when you think you're protected. Let's dive in.
Okay, so let's start with what seems like a really simple question. You've paid your premium, right? So you're covered. It's a deal. But what if I told you that's not always the case? What if the answer is no?
Here's the deal. We're seeing this really worrying trend where people who have dutifully paid their premiums are getting rejected later on, and that leaves them completely uninsured, often at the absolute worst possible time.
And what's so scary about this is that it's not just a few isolated mistakes. This isn't a service failure here and there. Our sources are pointing out that this is becoming a systematic process, a kind of deliberate operational choice that really shakes the trust we put in insurance companies.
So how on earth is this happening? Well, it all boils down to a critical reversal in the insurance process. The normal sequence of events is getting flipped on its head, and that's what puts you, the customer, at a huge disadvantage.
Okay, this slide right here lays it all out perfectly. On the left, you've got the correct way. You submit a proposal, the insurer does their homework to assess your risk, and then they accept you. Only after that do you pay the premium, and poof, the risk is theirs. But now look at the hidden trap on the right. You pay the premium first. The real evaluation happens later, and that's where the danger is.
And just so we're all on the same page, let's quickly talk about what underwriting actually is. This is the insurance company doing its due diligence. They're digging into your health history, your data, everything, to decide if they even want to offer you coverage and at what price. It's the risk assessment.
Right, so here's the absolute heart of the problem. When you pay your premium before that underwriting is done and dusted, you haven't actually secured your coverage. All you've really done is given the insurance company an interest-free loan while they take their sweet time deciding your fate. The risk of rejection, it stays squarely on your shoulders.
You know, talking about this in theory is one thing, but what does this trap actually look like in the real world? Let me tell you about a story from our source material that shows just how damaging this can be.
So picture this. A colleague, just like you or me, is trying to do this smart thing. She finds a new insurer with a better deal for her family, she fills out the forms, pays the premium, and naturally assumes, great, my family is protected. But she wasn't.
And this is where things just spiral out of control. Look at this timeline. In November, she pays for the new policy. So in early December, she lets her old, more expensive policy lapse. Then, boom, mid-December, the rejection letter arrives for one of her family members. All of a sudden, it's late December, and the grace period on her only guaranteed policy is about to run out. She is right on a cliff edge.
And you know, the craziest part? The reason they gave for the rejection was flimsy, to say the least. Something her own doctor disagreed with. But honestly, the reason didn't matter. It was the timing. That was the real weapon here. This last-minute rejection was designed to pressure her into a corner, forcing her to accept the worst policy just to avoid having no cover at all.
And as if all that stress wasn't enough, think about the money. We're talking about family premiums that can easily be over ₹1,00,000. Her funds were just stuck in limbo with the new insurer while she was staring down this massive coverage gap. And of course, there was no compensation for the delay or the risk she was forced to take.
Now it's really tempting to hear that story and think, wow, what a terrible insurance company. But the truly scary thing is this isn't just a one-off. This is allowed to happen because there's a fundamental gap in the regulations that are supposed to be protecting us. When you dig into it, the regulatory framework is basically silent on what happens if an insurer takes your money and then says, no thanks. There's nothing to stop them from collecting premiums early. There's no clear accountability for anyone in the chain. And there are no hard and fast rules about how quickly you get your money back or if you get compensated for the trouble. It's a huge loophole.
Okay, so what are we supposed to do while we wait for the rules to catch up? How do you defend yourself against this? Well, the good news is our source gives us a really clear 3-step defensive playbook to keep you and your family safe.
Step 1, you've got to start this whole process super early. We're talking at least 2 months before your renewal. Step 2, you have to be persistent. Follow up, follow up, follow up, and get everything in writing. And that brings us to step 3, which is the big one, the golden rule.
Okay, listen up. Because if you only remember one thing from this whole explainer, please make it this. Do not, under any circumstances, allow your current policy to expire until you have the new, formal, written policy document in your hands. Even if that means paying for 2 policies for a little while, that peace of mind is priceless.
All right, so let's bring this all together. What's the final takeaway from all this? In a system like this, where does the buck really stop?
You know, there's a quote in the article that just nails it perfectly. It basically means that for now, while we wait for the regulators to close these loopholes, the only person who is truly looking out for you is you. Your awareness is your only real shield.
So I'm going to leave you with a question. Now that you know about this risk, I want you to really think about your own situation. As your next renewal date gets closer, ask yourself, is my family's coverage as secure as I think it is? Because your financial health, and maybe even your physical health, could depend on that answer.